So the world is currently crippled with debt. I meet with a lot of students, and some of these students can even get vehicle finance in their final year. You know, it's as easy as just picking up your phone and calling a credit provider and you can borrow money. And before you know it, you're swamped and snowed with debt and you find it so hard to get out of this. We meet with Regis, we meet with doctors in private, which has got no assets to show. And I'm saying this very respectfully, no assets to show, no beneficiaries, but unfortunately sitting with 200,000, 300,000, 400,000 Rand of debt. So today we're going to cover what is debt and what is the debt that you should avoid, and how can we implement effective measures to help you kill this off. Right up next. So firstly, let's lay a bit of a foundation. There's two types of debt. You get unsecured and you get secured debt. Unsecured debt is typically something where there's no repercussion if you can't pay back the debt, in layman terms. So basically, let's say you buy clothes, it's not like the company is going to come and take back the clothes. Or if there's just a personal loan, they've given you the money, you know, what can they take back to repossess? Whereas secured debt is typically where there's a mortgage, vehicle financing, they can actually come and repossess the car or repossess the property in order to make sure that they can cater for the outstanding debt. So most people get caught in unsecured debt. Unsecured debt is typically at very high interest rates, purely because institutions want to manage their debt. For them, it's a risk. In order to get return on their investment, remember high risk, high reward, they have to then levy a higher interest rate. So typically you would be looking at 15 to 20% interest that you would be paying on these sort of vehicles. So a couple of tips that we're going to walk through. If you are one of these professionals, you're watching this episode today, apply these tips immediately, get results, and get out of debt as soon as possible. So the first one, budget. It's time for you to trim your trees. It's time to attend to your garden. We just moved into a new place and there's the most beautiful garden. And within a week or 2 weeks, if I don't look at that thing and if I don't look after the garden, obviously weeds are going to start growing and this thing is just going to get out of control. The same thing applies to a budget. So a lot of people think I've started budgeting in the beginning of the year when I wrote down my New Year's resolutions and it was all goals. And now halfway through the year, it's like, you're just winging it. A budget is something that you got to nurture. I would even recommend to break your budget down to a weekly budget. The benefit of having a weekly budget, let's use groceries as an example, is that if you fail your budget in a week, you can take on an extra effort to make it up in week number 2. Whereas if you commit to a monthly budget, it's sometimes very hard to navigate, especially if you've got food that you need to buy. Some of the food goes off. All of a sudden you budgeted in a certain way or there's a massive expense. Weekly budgets makes it a little bit easier. And it also helps you to celebrate the weekly goal if you've managed to get through to it. Also have a look at your needs and your wants. The stuff that you don't need, it's time for you just to trim those trees and to try and cut the fat. Get out of a luxurious lifestyle. I always say to clients, it's literally just a season. It's not the whole book. It's just a chapter. And make sure that you can get free of those expenses that just drags on and on. Secondly, we're going to look at taking on minimum payments if you've got a couple of debt repayments. So let's say, for example, you've got a personal loan, you've got your credit card that you need to pay back, you're sitting with student loans, etc., etc. The first thing that I would recommend is to talk to the institution that you've got the debt through, take a minimum payment on that debt. So if you used to pay 5,000 Rand and they say, oh, we're willing to give you 2 for 2,000 Rand repayment, then take minimum payments. What you then do is you look at which one is the smallest, or which one, a lot of people like to do this as well, which one carries the highest interest rate, because technically speaking, that is the most expensive one. I personally like to look at the smallest one because, again, money is an emotional thing. And if you pay off that smaller debt, all of a sudden you've got an extra 2 or 3 or 4 grand that you used to spend into that debt that you can then channel to the next portion of debt. You repeat this cycle continuously, continue to repeat up until you get to a point where you're completely debt free. The third one I want to talk about is to try and use cheaper debt. Remember we spoke about interest rates? So typically a mortgage or secured debt is a little bit cheaper than your unsecured counterparts. So not all, unfortunately, but not all secured facilities would give you this option, but most do, where they actually give you something which they call a future access bond, or if you've paid off some of the capital on your home loan, then there's a small portion that you can actually access. Now, you need to run the numbers, and you obviously need to talk to a financial advisor or talk to your banker to make sure that you don't put yourself off in a worse position. But what most generally what happen is if you take, let's say, for example, 30,000 Rand or 40,000 Rand from your home loan to pay off something like a credit card debt, your cash flow per month automatically is better because the 30,000 Rand is on a lower interest rate over a longer term on your home loan, which then allows you from a cash flow perspective to use what you used to pay towards the other one to pay off some of your other debt. So again, just repeat the cycle up until you get to a point where that debt is also paid off. Fourthly, for some of our elder listeners, look at universal policies. A universal policy is a typical policy that's been discontinued for time being in South Africa, where it used to be an investment portion as well as a risk portion, like a life cover or a disability benefit built into one. These policies are still active. They've generally just been discontinued for time being, and mostly because most investments and risk policies become complex on its own. So you get a risk specialist and you get an investment specialist, which help you plan accordingly for those two needs on its own. To get back to the universal policy, if you are elderly, ask your financial advisor or ask someone to have a look at whether you've got some of these policies and whether there is a maturity value or there is a surrender value that you can access. Look at the T's and C's. The last thing you want to do is cancel a policy to access the money, but then you lose potential cover. Sometimes what you can do is you can also split the two. So you keep it with the institution. Let's say you're with Company A, you've got a R1 million life cover policy, and there is a surrender value of 100,000 Rand. You simply split it so that the million stays on its own. The 100,000 Rand then becomes accessible. It's a separate investment. You access the money and you pay off your debt. What does it help that you're sitting with 15 and 20% interest rate debt that you need to pay back, but you're only making 7-8% on this investment? Goal is to try and get clear from any debt, restart, and build your foundation successfully. Lastly, and a lot of people will definitely probably disagree with this statement, but I would say try to seize some of your longer term investments for time being. Specifically, if you're with new generation platforms, they allow for you to stop indefinitely. Remember, it's just a chapter, it's not the whole book. And if it means that if you're allocating 5, 10, 15% of your current gross professional income towards a retirement annuity or towards an endowment policy, try to say, well, if I seize this for 6 months or seize this for 12 months, I can use that money to get clear of debt. Again, you're probably doing 10, 11 or 12% on that investment, whereas the interest rate is costing you 15 or 20%. Try to get that off the table and then refocus on your investments. As a matter of fact, you can then use all the money that you used to spend on the debt and throw that back into your investment. So this is just a couple of tips to help you get clear from debt. I think debt is an awful thing. It's one of those things that places a lot of financial anxiety on a lot of professionals. Try to avoid it. Money is an emotional thing and it's a discipline thing. It is something that you need to focus on changing your behavior and the way that you spend, your spending habits, and make sure that you can live a life of financial freedom. If this is the first time that you are watching Money and Medicine, go check out our YouTube channel, go check out some of the social media content that we post. We're there for medical doctors to change the way that you look at your financial affairs. We've seen that you study 6 years, you potentially study 10 years, and nowhere in that degree are you ever exposed to financial terminology. Yet, you have to think like a businessman or think like a businesswoman if you open your own practice. Money and Medicine is that platform that want to educate you, empower you, and edify you, and walk this journey with you to live the life that you want to live. Until next time, plan the plan.